ExxonMobil out with earnings earlier this morning. The oil giant reporting an adjusted $2.83 a share. That was much better than the $2.59 that the street was looking for. That stock, after trading lower ahead of the release, has now turned up. It's up by about 42 cents. Joining us right now is Darren Woods. He's ExxonMobil's chairman and CEO. And Darren, thank you for being with us this morning.
Thank you, Becky. It's good to see you again.
Good to see you, too. We saw very strong numbers coming in with this, even though oil and gas prices have come down from the record levels we were looking at last year, and that's in large part because of higher margins. You want to talk a little bit about what was driving things?
Sure, yeah. We're real proud of the results this quarter. I think it reflects the hard work of all the men and women at ExxonMobil and, frankly, all the changes that we've made over the years. A record first quarter for us off of a record 2022. And reflects, I think, the changes that we've made in the organization, the streamlining we've been doing, the focus on generating value all along our value chains. You know, we've cut out over $7 billion of structural cost. We've got an investment portfolio that I think leads the industry. We're continuing to grow production. If you look at the first quarter of last year to the first quarter of this year, we've added 300,000 barrels a day of production in total. We've brought on in the first quarter the largest refinery expansion in the last decade in the U.S., and we are bringing on chemical plants in the U.S. So I think as you look across the portfolio, a really good mix of advantaged investments and really strong performance by the organization.
In terms of what you've seen in Europe, both you and Chevron go out of your way to kind of point out the higher taxes coming from Europe on the energy sector that they've been putting in. These are the windfall profit taxes that that the UK and other places kind of put in last year. It cost you about $200 million in additional cost. Is that something that means that you will be less interested in working in those markets, or is this just a cost of doing business?
No, I think you touch on a really important point. You know, Europe in the base case is a challenging market for our industry and has been for a long time. We've been one of the few international oil companies that have actually invested in improving our production facilities there, and to have that hard work and the benefits resulting from that work be taxed and taken away from the company, I think does put a different perspective on the investment opportunities in Europe. Unfortunately, there's a bigger issue here. In that, you know, the world balances, world supplies of both oil and gas are fairly constrained today. And we've had some Europe's been fortunate with respect to some of the weather and what China demand was doing last year. If demand turns around, things pick up, I think we're going to see some very tight markets. We're going to see, I think, higher prices. And unfortunately, I think Europeans will pay a price for that by discouraging the investment required to bring long-term production on sustainably.
Why do you think we haven't seen higher prices to this point? Because a lot of people have pointed to everything that's happening on the production front, tightness in places. You've got OPEC that's going to be cutting more than 1 million barrels a day starting on Monday next week. And yet, if you're looking at WTI, price is still pretty stubbornly below $80. It doesn't seem to break out to some of those higher levels that a lot of people had seen. This morning, we're looking at 75.
Well, I think, you know, generally, if you want to kind of gauge where prices are going, you've got to gauge where inventories are at. We're coming out of a period of fairly low demand. Supply's been consistent, and so you've built inventories, and that keeps, I think, stability in the marketplace, which, frankly, I think is a good thing. I think the industry could be very successful at the prices that we see today. So we're certainly not in a low period by any stretch of the imagination. But the challenge will be that as demand grows and, say, going into the summer driving season, as people begin to take vacations and travel and airline passenger miles kick up, I think you're going to see that those inventories begin to draw. And then depending on how robust the economic picture is around the world and how China comes out of its COVID lockdown, that demand will draw the inventories, and then we'll get back into a tight position. There's not, you know, a lot of levers to pull to bring on production in the short term.
So even if the United States heads into a recession, your call is that we'll see higher energy prices this year, in large part because of China and other international growth?
I would say it just comes back to how the demand plays itself out. I have a very similar view, as I've heard many of you guest on your show over the last several weeks and months. it's a fairly mixed picture today. There's a lot of seasonality in our business. We're coming out of, what is typically a lower demand period where we do a lot of maintenance on our refineries. When those refineries kick back in again, you see a kind of a flush of supply, and so you see some margin pressure around this time every year. And the question will be, as you come out of that, do you see demand pickup? The gasoline demand looks pretty healthy right now. I think the airlines are predicting a good travel season, so I do think that will have a significant impact given the capacity that we have in the marketplace today.